Volatility is back. Since the end of September, the S&P 500 has moved more than 1% on about half of the trading days, compared to 0 days of such magnitude in the third quarter of last year. Most of these moves have been to the downside, as the S&P 500 has fallen about 10% since then. So is this the end of the bull market? It might be, but trying to predict the exact end of a bull market is like trying to predict when the next earthquake will happen. We know that the pressure on the fault is building, but we don't know when it's going to let go. We've been tracking 3 possible culprits that could precipitate the end of this bull market: valuation, trade wars, and the Fed over-tightening. The recent downturn in the market, along with strong earnings growth, has brought the S&P 500 forward PE ratio to about 14.5 times. This is lower than the 25-year average and far below the euphoric valuations seen in 2000 during the dot-com mania, leading us to believe that excessive valuations will not be the reason for the end of this bull market. So what about trade wars? Tariffs and the ongoing trade battle with China have created plenty of uncertainty, which stock markets hate, but we do not think trade wars on their own will bring about the next economic recession. Most U.S. companies have reported that they plan to pass the tariff costs on to customers in the form of price increases. We also see inflationary pressures in the tight labor market, with low unemployment and rising wage growth. However, these pressures are mitigated by a softening housing market, lower oil prices, and a slowdown in China, which is exacerbated by the trade war. The Federal Reserve is tasked with managing this inflation and keeping it from getting out of control. One of their primary tools is the federal funds target rate. The Fed raised its target rate to 2.5% in December, the 4th rate increase of the year, although it plans to slow its rate hike program in 2019 with only 2 hikes planned. Rising interest rates typically slow spending and growth as it becomes more expensive for consumers and companies to borrow money. At a certain point, interest rates will reach a level where they hamper economic growth. This is what we believe will bring an end to the current bull market. While we remain fully invested at this time, we've begun to pivot toward defensive stocks that should hold up well in a recession. These include companies whose revenue is less dependent on robust macroeconomic growth, as well as value stocks that typically have low valuations and high dividend yields. We've also added more short-duration fixed income securities, which have begun to yield more in a rising interest rate environment.